So moving on in chapter 3, next question that we get is, who is responsible for paying the taxes on income whenever it comes in? Well, the person who receives the income, whether they benefit from it or not. I mentioned earlier that you could receive, let's say, a house from someone, or you receive a prize on a game show, and it's something you don't want. That doesn't matter. You are still receiving the income. Therefore, you're responsible for paying the taxes on it. Let's talk about marriage for just a second, because this is one of the areas where this question comes up quite a bit. In the United States, there's basically two different ways that the government looks at how income and property is brought into a marriage. 41 of the states use what's called a common law system, and this is not common law marriage. This deals with property rights and income. 9 of the states use what we call a community property approach. Common law says that income is usually taxed to the person who owns it. So if you are married, one of you earns an income and the other one doesn't. You have the ability in your marriage to say the person who earned that income is responsible for the taxes, unless you make the voluntary decision to file your taxes together. Now, what that also means is even though you are married, you can each individually own your own sources of income and file your own separate tax returns. So you could, if you are married, have your own investment account that earns its own income that is not required to be shared with your spouse. If you share it, that's a voluntary decision that you make. This is the category that Missouri falls into. Now, how does that vary from community property? Well, community property in those 9 states, anything that comes into the marriage after the marriage has started is jointly owned by both of them. Wages, rents, investments, it doesn't make any difference if it is in one person's name. If they're in a community property state, both people in the marriage own it. Anything owned or earned before the marriage is still considered separate, though. This comes up a lot whenever you see big celebrity divorces out in California, because California is one of the community property states. If one of the big celebrities earned all kinds of money during the marriage and the other one doesn't, according to community property laws, they both own it together, equally split down the middle, unless they agree to split it differently. We're going to talk about divorce a little bit more here in a minute. It's the last topic we're going to cover in videos today. Next thing I want to talk about is, when is income taxable? I'm going to make you remember back to your accounting class, because you learned something then that actually answers this question, but I want to make sure that you understand it in relevance to what we're talking about here. And that is, what is the difference between cash basis accounting and accrual basis accounting? Cash basis accounting says that income is recorded and is taxable whenever the payment is received. Whereas accrual basis says it is taxable whenever the payment is earned. What does this mean? Okay, so you own a small business, you've made a $5,000 sale to one of your customers on December 25th. You've told them that they have 30 days to make that $5,000 payment on the account. If you're dealing with cash basis, and that customer does not pay until the middle of January, then that income is taxable in January, because it's whenever you actually receive the payment. Whereas in accrual basis, in this scenario, you would be taxable for that in December. You'd be responsible for the taxes in December, because that's when you earned the income. You haven't received the money yet, but that's not relevant in this situation with an accrual basis. The same situation works with expenses. For expenses, they become taxable in the cash basis when the money, or however the payment is made, is actually given to the person that it's owed to. Whereas with accrual basis, the expenses are taxable whenever you owe it, not necessarily when you pay it. So what else is the difference between these? Well, on cash basis, there are businesses who extend credit. but run their books on cash basis. So they may have customers who don't have to pay them for 30 days down the road. But if you're filing your taxes with the government under cash basis, you're not going to be counting that income or those expenses until the payment actually changes hands. Most individuals and most small businesses use cash basis. There are some that the IRS requires to move over to accrual basis, and the biggest determining factor on that is, does the business carry inventory? Because if you're bringing in, let's say, furniture inventory, and it's going to sit in your warehouse for 2, 3, 6 months until you sell it, then that's an argument to be made for the fact that you really need to be working on accrual basis. One last thing that I want to make sure that you understand under this topic is what we call constructive receipt. Now, what that means is, we've talked about cash basis being income when the payment is received. You may work for a company that loves the fact that you are working for them, and you are doing such an incredible job, they are going to give you a bonus on December 31st and say thank you for doing the hard work. Now, all you have to do is stay employed with us until March 31st. And if you are here as of March 31st, we will let you have your bonus. In this situation, income is not going to be considered received or taxable on December 31st because you don't actually have the ability to get to the money yet. They may set it aside in a separate account and say, here it is, it's in there, it's yours, but you don't get to have it in your hands until you follow through on the rest of these requirements. Okay, that's these two topics. One more video and we'll deal with the last two topics, and then it's time for you to get on with your chapter.